Now, for more on what impact this rate rise will have, let's cross to Sara Hsu, Assistant Professor of Economics at the State University of New York at New Paltz. Welcome to the show.
Thanks for having me.
Now, obviously, there was a lot of back and forth throughout the year, with some analysts thinking perhaps the Fed should have already raised rates. So why raise them now?
Well, there's been a lot of difficulty in terms of emerging markets. We've seen struggles happening in China, Latin America. We've seen Europe struggling to maintain growth and also at present to reach target inflation rates. So Janet Yellen has telegraphed that she's more than willing to take into account emerging market woes. And I think that's been one of the biggest drivers in terms of keeping the interest rates low to date.
So let's look at some of the regions that she was looking at. The Fed says that it's going to be tightening, but it will be gradual. But they are still raising rates, while you have the European Central Bank, on the other hand, leaving the key interest rate unchanged. Why these different courses of action?
Well, the European Union is still not doing as well as it wants to do in terms of target inflation. Its growth looks relatively good. It is hovering at around 2%, but in terms of inflation rates, it still is driving to get to the point where it wants to be. So the European Central Bank has chosen to continue quantitative easing for the near future.
And let's also look at some other regions. Let's look at also Asia and Latin America. What were some of the main aspects of the global economy that you think factored into this decision to raise rates?
Well, I think that the global economy is still struggling. We see particularly in China that there are a lot of currency depreciation pressures, which will certainly build due to the Fed interest rate hike. We also see struggles in South Korea in terms of economic growth as well as political struggles. They just have eliminated their president, President Park. Also, we see in Latin America, we see some political struggles there in terms of Brazil. They're still having ongoing fraud investigations into the current president. And we see ongoing struggles with Venezuela and Ecuador. So I think that the Fed decision to raise interest rates had more to do with the outlook in the United States than in emerging markets, although certainly the decision to raise interest rates gradually will help emerging markets to adjust.
And as you mentioned, all these different regions dealing with their own set of difficulties. So what sort of impact do you expect to see when it comes to the course of action taken by other central banks, perhaps, moving forward?
Well, it's going to be difficult for other central banks to engage in quantitative easing, monetary loosening, because when they do that, then the United States interest rates look higher. The United States looks like a better place to invest. And essentially, this drives down currencies in other countries. And so it makes them less attractive. So they will have to take all of this into account.
So in the big picture, when we look, which are some of the sectors that are most sensitive to this change in key interest rates?
Some of the sectors that we've already seen declines in the United States in particular include the utility sector, whose stocks are viewed as close to bonds. And we also see declines in the energy sector. There's usually an inverse relationship between U.S. interest rates and commodity prices, and energy prices are certainly a factor in that. Also, real estate prices are expected to, or stock prices are expected to fall.
And just lastly, some analysts believe that President-elect Trump poses the single biggest risk to the global economy. And we've already seen that he's been critical of the Fed and Chair Yellen. What are your thoughts on how his potential Fed shakeup could impact the global economy?
Well, it may have a very adverse consequence. One of the reasons that the previous global financial crisis came about was because Federal Reserve Chairman Alan Greenspan allowed interest rates to remain low for such a long time. And essentially, this allowed debtors who had relatively poor credit backgrounds to obtain mortgage loans that they should not have, thus causing the subprime crisis, which led to the larger crisis. So I think that if President-elect Trump allows the Federal Reserve to to take a more passive stance, or forces them rather to take a more passive stance, and to maintain relatively lower interest rates, this could have disastrous consequences in terms of creating asset price bubbles.
We'll have to leave it there, but thank you so much for your insights, Sara Hsu.
Thank you so much.
Assistant Professor of Economics at the State University of New York at New Paltz.